Since 2008, the U.S. Central Bank has pumped nearly $4 trillion into the global economy. Besides boosting liquidity, quantitative easing has also lowered U.S. interest rates to record lows. But instead of causing a spike in inflation as many had feared, some of the money began flowing into countries where yields were higher. MANN is chief economist at the Organization for Economic Cooperation and Development.
Emerging markets have been the beneficiaries of investors' search for yield.
Among the beneficiaries, the BRIC countries, Brazil, Russia, India, and China. But now, with U.S. interest rates set to rise next year, Brad McMillan at Commonwealth Financial Network says some of that money will start flowing back to the United States. He spoke to us on Skype.
Because with U.S. rates starting to rise, the attractiveness of the U.S. as an investment destination continues to increase. You're going to see a lot of capital that went to the emerging markets potentially come back.
That's not necessarily a bad thing, says the OECD's MANN.
Part of the reason why that's the case is that tapering has happened along with a speed up in the U.S. economy. So the emerging markets, even as capital was being reallocated, ended up doing better from the standpoint of exporting.
That's because a stronger dollar makes foreign exports cheaper. On the other hand, it's also likely to produce increased volatility, the ups and downs in financial markets. Mohammed El-Arian is chief economic advisor at financial services firm ELLICE.
Why has volatility returned to the foreign exchange market? Because we're going from a world of multi-speed central banking to multi-track central banking. In the old days, everybody was doing the same thing, just different magnitudes. Now, we have two central banks that are lifting their foot off the accelerator, the Bank of England and the Fed, and we have two other central banks that are putting their foot more on the accelerator, the ECB and the Bank of Japan.
Experts say price volatility is an integral part of economic normalization. International finance consultant James Berkeley says it may prove a turning point for the global economy. He spoke with us on Skype.
Governments really should be focused on trying to maximize international trade and to really take advantage of this period of beyond recovery. We're now into a period I would describe of serious sustained growth.
Despite the economic slowdown in parts of the world, experts say a stronger U.S. economy, along with lower oil prices, is likely to boost consumption. And when consumers buy more, emerging markets, which produce more than 35% of the world's goods, are likely to be among the winners in 2015. Arcega, VOA News, Washington.